Holiday spending can't offset trade concerns. The market has headed into what is usually a positive period. Both the year-end and post-midterm months have traditionally generated some good returns. But that's not apparent this Monday. Stocks were hammered across the board. The Dow Jones Industrial Average dropped 602.12 points, or 2.32%, to 25,387.18, while the S&P. Maybe the weakness shouldn't be surprising. The market rebounded a bit last week from October losses, but the internal health of the recent rally hasn't been impressive, according to Liz Ann Saunders, chief investment strategist at Charles Schwab. While stocks were oversold at the late October lows, and investor sentiment had moved from excessive optimism to pessimism, there wasn't quite the type of panic selling and investor despair that often serves as a sign of a firm bottom. This was supported by the low level of the VIX, the CBOE Volatility Index, during the October correction. VIX is usually used as an indicator of the market's forward-looking volatility. Fundamentally, the major issues that contributed to the correction, the trade dispute with China, tightening financial conditions, and concerns over the Fed policy, remain in play. According to Saunders, little seems actually resolved. She expects the market to see ongoing bouts of volatility heading into 2019. The Wall Street Journal reported today that the Trump administration is looking to broaden its battle with China beyond tariffs. Export controls, indictments and other tools might be used to fight the theft of intellectual property. Julian Emanuel from BTIG worries that should the tension with China continue to escalate and the dawn of an economic Cold War started to show, the stock market might suffer. Emanuel writes in a Monday report that U.S. stocks rose 830% in the 29 years from November 1989 to November 2018, while the prior 29 years, a time of an arms race with the Soviet Union, and the Vietnam War, only saw growth of 564%. We believe that the lessening of tensions with the U.S. rivals in war and peace, the Soviet Union, now Russia, and China was part of the reason such a virtuous economic and investing climate has been possible, he writes. The peace dividend might be fading this year, however, as the trade war with China intensifies. Although earnings have risen over 20% in 2018, the trailing price-earnings ratio has declined to 19.4 times from 22.3. 10 years into a global equity bull market, the outcome is less than certain and the potential to roll back time to a different, less profitable era is very real, writes Emanuel. The midterm election isn't helping. Global stock markets are likely to remain concerned by the trade tensions even though Democrats gained control of the House of Representatives, writes Schwab Saunders, who notes that congressional approval is not required for the trade tariffs or other actions Trump has implemented. However, there are other election-related patterns worth noting. Over the past 25 years, midterm election years usually saw higher international stock markets in November, except for 1994 and 2010 when the U.S. dollar rose 5%, according to Saunders. Although the greenback has been on the rise since the election, another indicator might offer some different insight into the future. She noted that President Trump's approval numbers have been a good indicator of U.S. dollar moves since his inauguration, with a delay of about 90 days. This may be because the approval number captures many things respondents attribute to the president, like the growth of the economy and inflation, which can drive the value of the dollar, she writes. If this relationship continues to be true, President Trump's dropping approval rate recently might suggest a weakening dollar, and hence a chance for international stocks to rebound from a tough October. Write to Evie Lou at evie.lou@barron's.com.